Hit it. Go.
That's the worst hit it I've ever fucking heard.
Just keep going.
It's April 3rd, 2020, episode 74. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we're pleased to welcome Steve Sosnick, chief strategist at Interactive Brokers. Steve gives us an inside view of the early days at Timberhill and what it was like to be an option market maker. Then we have the privilege of welcoming back Barton, who will give us an update on the coronavirus situation. He draws out some paths for both the virus and the markets. And then finally, we get Patrick's Talking Charts segment.
And then we'll finish with This Week in Trading History, our WTF video, and the top 3 things to watch next week.
It's our pleasure today to welcome Steve Sosnick, the chief strategist and Interactive Brokers head trader. Steve, it's a pleasure to have you back on the show.
Great to be back. I missed it.
Yes. Now, you were probably one of the original Huddle guests. And for those who don't kind of remember or, hadn't tuned in back then, why don't we go through your history and a little bit of, who you are and how you came about to be in your position at Interactive Brokers. So let's start with, where did you go to university?
I went to the Wharton School at the University of Pennsylvania. I got my bachelor's in economics and master's in finance. I did a 5-year program. I guess that makes me a co-alumnus of with our president. But
Hold your head up high. Quiet about that. You're supposed to be a little more quiet about that.
We are kind of quiet about it. Actually, it's interesting because Biden now is running a think tank of some sort over at Penn. So, and my son, who went there as well, at one point had Tiffany Trump and Naomi Biden, Joe's granddaughter, in his English class, which he said discussing the poem Howl with them was quite a fascinating thing.
It's a little incestuous.
Yeah,
okay, so you went to Wharton, and then did you go straight from there to Wall Street? How did that work?
I did. I was a summer when my friends were getting full-time jobs, I got a summer internship at Salomon Brothers, and that was just wild. It was in the sales and trading area. It worked out well, obviously, because they offered me a job on the way back. I actually deferred it for a few months. It was a raging bull market at the time, so you could do such things. Went off and took classes in Japan for a summer, just because I wanted to live there. But the real excuse was to put a backpack on and go around Asia, which was a lot of fun. So I got back and went through the Salomon Brothers sales and trading program, pretty much just in time to finish in time for the big market crash of '87.
Your timing was impeccable.
Oh, impeccable! My role that day was, this was when when you'd make NASDAQ markets, basically you just have the screen and you'd have to call whoever was at the top of the book if you wanted to hit a bid. And my job was to move our prices continuously, basically just go through our list and just move them down, me and one other guy. That was our entire role. And do not pick up the phone under any circumstances.
It's amazing. People probably don't understand how that used to work. Why don't you explain a little bit, for the youngins who kind of can't even imagine not trading electronically? Why don't you talk about how the NASDAQ used to operate? Because it used to also, not only was it by hand, but it was also a spread that was kind of often very wide. And if you put a bid in the middle, you wouldn't necessarily get hit. It could trade basically at a price lower than your bid, and you wouldn't be guaranteed a fill.
Oh, it was terrible. It was more, the prices were more or less indicative rather than actual. I mean, if a dealer called you up, you were obligated to deal with them, but you had to pick up the phone, and someone would call in, and let's say you picked up the phone on the dealing desk and you were, 50 bid for Microsoft or whatever. And it would be, you'd basically have to get on the phone and, you'd pick it up and the guy would go, this is whatever brokerage firm. I want to, 2,000 Microsoft at 50. And then you'd have to shout out to whoever the market maker was in Microsoft and go, 2,000 Microsoft at 50, it's blah, blah, blah. And then you would trade, the guy would say, well, I buy 1,000, move, or something like that. Or I buy 200, you'd have a size that you'd put up and, you would only be obligated to trade whatever your posted size. You'd keep a small posted size. So you wouldn't be obligated to trade very much. This was back in the day where I used to refer to the other, a lot of the NASDAQ market makers as the over-the-counter crime families to a certain extent, because it was very much, and there were the lawsuits to prove it. It was very much the Wild West. And, I remember very vividly, I was trading, it was Falconbridge Nickel, I think. So there goes.
Oh, that was a good Canadian name.
Absolutely. Well, I was in the foreign department. So I was actually allowed to trade on, I was one of the few guys, my group was one of the few that was allowed to trade on both New York and NASDAQ, because normally you were segregated by where your stuff, if you were a domestic trader, you were segregated by where your stuff traded, because the methodology of trading on NASDAQ versus New York was completely different. But in our case, being in the foreign department, we were segregated more by country. So, Verity and Nortel were my biggest names on the listed side, and Falconbridge was one of the biggest names on the OTC side. And pretty much this is like a museum of old Canadian names. I can go back through some more as well, but that was really what was going on. And so it would, I remember very vividly some guy call me up and go, "What are you?" Am I allowed to swear on this, by the way?
Yes.
Yeah.
Okay, well, good, because that gives you the full flavor of NASDAQ. What the fuck are you tightening the spread for? Because I think it was like 3/4 a quarter, and I went 7/8 bid, God forbid. And it was like, what the fuck are you doing? You got a fucking order? Get the fuck off the bid then. What are you making? You're ruining it for all of us. And it didn't really occur to me why, because when we were at Salomon Brothers, we were doing pretty much only institutional business. And so we just, we traded on the bid ask. We would occasionally prove the spread if it was a good customer, if we had, or if there were orders. If you were lucky enough to cross, we would actually just sort of take our eighth, because the customers were both sophisticated. And, so even if the spread was 3/4 a quarter, you'd agree on the trade. It would be, let's say, the figure an eighth, and each would, they'd let you build in a little bit of a spread, but not more than that. When we got to Lehman Brothers, which at that point was, I think it was Shearson, Lehman, Hutton at that point. I had about 6 or 7 different business cards in my couple of years there. And we got there, and one of the first things was, there was the listed side, and there was the institutional side and the retail side, or the listed side and the OTC side. And those two departments hated each other, couldn't stand each other, because the listed guys were the old Lehman guys, and the OTC guys were the old Shearson guys. The Shearson guys dealt with retail. And we saw this for the first time, and we were like, is this legal, what I'm about to tell you? And it was some stock that was on the recommended list, and some institution wanted to sell, 20,000 shares at, again, I'll use this 3/4 a quarter market, at 3/4. And they went out, whoever was in charge of mobilizing the retail force was like, all right, guys, I got a special for you. This stock is on our, it's a recommended buy. We will sell you, we're going to buy this stock in, and, it's showing 3/4 a quarter. You get to buy it at 7/8 and give your customer a fill at a quarter. We're like, huh? You guys are literally we're like, is this legal? What did we get ourselves into? And, and that was one side of it. And, and the problem of trading both listed and over-the-counter stocks in an environment where the two desks were run by different people, both of them hated each other. That was a fairly untenable situation. So I had to get out of there after we all left after a couple of years, because that was a nightmare.
So Steve, you were there, and you had gone from Salomon Brothers to Lehman, but then you decided that Lehman wasn't for you, and you actually quit and went to your current firm. Why don't you talk to us about what attracted you to Interactive Brokers, and how come you stayed there for so long? What is it, a quarter of a century now?
Yeah, just about. By the way, just to age myself a little more, there was a couple of years at Morgan Stanley.
That's right. I'm sorry. Yeah.
Which I did for a little while. That was, again, foreign department, pretty much same stuff, less colorful. Morgan Stanley was never quite as colorful. But I was realizing that, okay, I'm on my third job at this point, doing international trading. It was fine, but perhaps I needed a smaller firm. And literally, I found some ad. My wife actually found it, some ad in the New York Times business, the New York Times want ads. Firm is looking for an experienced equity trader with some knowledge of options. I did trade a lot of warrants while I was at all three firms, mostly Salomon and Lehman, very little at Morgan Stanley. And I'm like, yeah, that sounds interesting. I'll call it. I'll see what it was. And it was Timber Hill, which was what we called ourselves back then. We were basically strictly a market making firm. And they were making a big push into equity options market making. and realized there was no one who really specifically knew a lot about the equity markets. There was a lot of quant knowledge. There was some good options and futures knowledge, but there was really no equity people there. And so I became the equity guy. And I enjoyed it. I really wanted, when I was at Morgan Stanley, I was developing some trading models and stuff like that. I wanted to get something that was much more model-based trading. This was almost all model-based trading. My role was to figure out when the models didn't work or when there was news that really couldn't be encompassed by a trading model. And it was fun, and it was very profitable. It was good along the way. I became a partner in the firm, and so that kind of makes you stick around a lot longer.
For sure.
And did all kinds of things. So
I'm kind of fascinated by Timberkill that then turned into Interactive Brokers. Like most people that deal with Interactive Brokers know them as this great electronic kind of client brokerage firm. But I'm not sure everyone's aware that they originally started as kind of a proprietary trading firm. And I'm kind of looking at it. It was founded in 1977 by Thomas. How do I say his last name?
Petterfy. Petterfy.
Okay, right. And so was he just kind of a visionary in terms of like obviously he has been immensely successful in terms of not just in the market making but even in your systems with the brokerage firm. Like, just talk to me a little bit about his vision and what makes Interactive Brokers so different, because I do think it's much different than any other firm on the street.
Well, Thomas is a very unique guy, and the firm was very much created in his image. He started on the floor of the Amex. Basically, he came here. He defected. This is when you used to defect from places. He defected from Hungary, essentially penniless. Got a job. Got a job eventually with Mokata Metals, which I think was also found. I believe I know it was Henry Jarecki was the founder, which I think is now part of Scotia. But I think he was also a Hungarian emigre, or maybe a generation ahead of something like that. And he hired Thomas, and Thomas basically Thomas, I guess, did a lot of his early computer programming. Decided he wanted to go out on his own. I think with the backing of Jarecki, but I'm not 100% sure on that. Went down to the floor of the Amex, and as this kind of odd guy with a funny accent. He wasn't immediately one of the guys, and figured, all right, if I'm not going to get the trades by being one of the guys when they come in, because an order would come in the pit, and it was sort of like the idea of the NASDAQ stuff I told you. Some order would come in, broker would walk in an order, I got a 50 lot at, at 3/8 of whatever, call out whatever line it is. And, the guys would sort of come up with their way of splitting it all up. And, they had their sheets, and they would adjust the price based on the delta. They would sort of look up and say, all right, well, the stock's moved $1 and the delta's 25. So I have my price on my sheet from this morning, which was, I should be a 5/8 bid. And all right, the delta, it's probably a good buy here at 3/8. I'll buy it. And they'd all sort of split it up. And he realized he wasn't going to really make his mark that way. And so he brought in the idea of computer, sending prices in with computers, making them dynamic. And that was really how it started. There was also some, at one point there would be computer screens with colors, on the sides of the pit, let's say of a futures pit. And that would be the color coding was where you should be, was your levels for buying or selling, which worked really well until other people figured out the color coding scheme. Still pretty much worked well, but then, the early portable computers came into play, and, we would have these guys on the floor. Fortunately, I never worked on the floor for us. I came in sort of to manage the prices that were going out to our floor traders. Those guys looked like Sherpas sometimes, with 2 or 3 of these primitive screens giving prices, so that this way someone would come in and say, I want to sell, I want to bid on, 20, IBM June par calls, and the person would punch it up and have their price quickly and have it be accurate, and that trade, and then they would enter the trade, and that trade would then be logged into our system, and we would then be able to hedge the delta. Basically, all the prices would adjust, and we would then have two-sided markets. Let's say in IBM shares that we would be posting without necessarily originally not being a market maker. We would act as one. We'd send out orders, and let's say so if we bought calls, we would sort of fade our price lower, on the stock, which would then hedge the delta. We would also sort of adjust all the various option prices, and as time evolved, we got faster and better at this, and it kept evolving. Shortly after I arrived, or around the time I arrived, we bought some little, I think it was actually a German software platform, called Interactive Brokers, and the web-based trading. It was really in its infancy then, but again, Thomas has had a career where he's been playing chess 2 moves ahead of the next guy. So he saw this coming, and it was originally was there to solve two things for us. As electronic trading came in, we realized most of it's the fixed cost. You've got to buy the wires or rent the space, whatever you wanted to call it. You'd have to, you'd arrange to get your connection to the exchange. And that was a mostly fixed cost. You would have order flow, there was a variable cost for when you do trades as exchange fees, and also you'd have to program all this stuff. Well, you realize that it's really not that expensive to build excess capacity and then sell it. And the marginal cost of a trade is effectively zero. Even then, it was very low. Exchange fees were always a very small fraction of it. So if you priced it just above your marginal cost, which is sort of standard economics, you could operate it profitably. And so this way we were able to lay that off. Also, although we never really fully utilized it, and it actually became an albatross at some point. The feeling in the early days was, if we're going to be making markets in all these places, wouldn't it be nice to drive order flow that we would, that we could interact with? That eventually morphed when brokerage got bigger than proprietary trading. The question was, the accusation was always, well, you guys are interacting with our order flow first, which was never true. And I'm telling you this, and I can't say it enough. It was never the case. We never preferenced ourselves. But that accusation stuck, which was one of the reasons we eventually moved out of market making, because we could never shake that perception.
Right. So actually, let's not before we kind of go on to out of the market making. I'm curious, because you're competing against the O'Connors of the world, the Citadels at that time, right? Like, would that be correct?
Citadel entered the business after we went public. Because
so you were already gone. Yeah, you were already gone.
No. We were still there when we went public. When did we go public? I think 2006 or so. The thing is, our track record was no one ever saw it. So people figured we were making money. They didn't know how much money we were making, which was a lot. And I think Citadel saw the numbers that we published in our prospectus and said, holy crap, if these guys are making that much money, we should be doing it.
I didn't realize that. Okay,
yeah.
So let's talk a little bit about that market making, though. So you're sitting there, you're giving bids and offers out there, and then as you get hit and you get long too much, you immediately hedge your delta. I get that, so you get yourself flat, but you'll get your point to you'll have too much gamma. So at what point are you kind of looking to try to, will you move your other ones? So let's say you get long a lot of IBM gamma. Do you go and try to sell some Microsoft that you see because you don't want to be too long on the gamma side? Like, how does it interact in between the different stocks and the different asset classes?
And I'm talking past tense because we're not actively doing this anymore. So you're getting me at a good time, because I can tell you kind of what we did.
Okay.
We basically would sort of manage it. The risks, I always looked at it as we had this big rubber ball, okay? Because it didn't exist in just 2 dimensions. It exists when you're options trading, as you guys know, you're existing in all different dimensions, as you alluded to. There's delta, there's gamma, there's there's individual risk, there's collective risk, et cetera.
Right.
And over the years, we developed algorithms to try to help us manage it. We actually very rarely would, let's say, if we bought IBM calls, we wouldn't necessarily go out and hit the bid in IBM stock. We would adjust everything, our bids and offers in stock and our bids and offers in calls and puts, to try to offset the various risks that we would have. And we would be monitoring for excess collective delta risk, excess individual delta risk, excess gamma or vol risk in any one particular name, excess gamma or vol risk, let's say in the tech sector versus the others. You could see how things, you would use correlations. I'm speaking very broadly, but use correlations to see, if you're too long delta in IBM or too long gamma in IBM, you could certainly, you would certainly want to think you'd adjust your pricing in Microsoft. And we rarely went out and hit bids or lifted offers. We were just sort of continuing to keep this ball as spherical. You can't see me talking with my hands, but I'm making a motion of keeping this ball as spherical as possible, so that no individual risk would be greater than our tolerance. We had very strict risk tolerances. Okay. And so what we would then do would be, the job of the actual people was to basically look for the situations where the system was not self-correcting fast enough or properly. You were
self-correcting, meaning that it's self-correcting, meaning that the natural buying and selling flow leaves you just earning the spread, and instead it doesn't self-correct, and you're left with too much risk of one particular direction.
Exactly. So, for example, one of the nastier ones would be, we find ourselves long calls, short puts in a given month. Okay. And the system would be pretty good. The net delta would would look really nice. The net vol would look really nice, right? Because effectively you're long and short equal numbers of puts and calls. You're not carrying a lot of gamma. You're not carrying a lot of vol. Your overall delta, you've hedged it with the stock. Well, you have to recognize that you probably have your dividend wrong, or your stock loan rate is wrong. And so that's where you have to sort of jump in, because the system sort of self-corrected itself, and it would start to move the prices. We would also take into account forward, too much long, short forward, stock forward. But that one, let's say we didn't necessarily move quickly enough, or before earnings, we would, it's normal to anticipate that a stock is going to have a bigger move on earnings, but you had to manage that risk very carefully, and make sure that, we would start with a guess of how, basically based on history. All right, some stock would typically move 5% on earnings, so we're going to assume that it's going to move 5% or more on earnings, but that's just a guess, and other people know this stuff better than you. And you had to respect the fact that they're pricing in 7% move on earnings. So you damn well better move your prices. Otherwise, you're just going to get short, you're going to get uncomfortably short wings. And that would be the way we think about it.
So you would, in essence, kind of surf along with the different prices, trying to manage the risk, but not just standing in there and saying, this is it, we're going to do a whole bunch here because it's cheap.
Generally not. The thing about market making is it's negative selection.
What do you mean by that?
Someone else is doing the trades, right?
I see.
You put out your prices. The bell would ring, and we'd have literally millions of prices out there. If you think about all the strikes on all the stocks that we would trade, and all the futures and options, and all the stock and all the bids and asks on stocks, it's probably 7 figures worth of bids and offers when the bell would ring. Boom. Well, if you just put them out there like that, you're trading. It's negative selection. You're trading what someone else wants to trade generally, right? You put it out there, and this is where you think you have a theoretical midpoint, and you price a bid and ask around it, and someone else believes you're wrong. And so you do that trade based with whomever selects that stuff around you. What it meant was we were not necessarily, we were very good pricers. We were really good hedgers, because we were very good at understanding that other people are taking this risk. Other people are forcing you to assume this risk, we better be pretty nimble about avoiding it.
Right. So one of the things that you just mentioned is all these prices, and the fact is now you don't do this anymore, but there's other people that have jumped into the void, and we mentioned Citadel, they're one of the big ones. Why don't you walk us through what happens in, like, for example, this environment where all of a sudden the market gets very thin, there's all sorts of volatility, it's very difficult for the machines to keep up and for the things to be hedged. Like, what would be, like, walk us through kind of what's happening behind the scenes with the market makers during these kinds of crises.
We used to have a big sign in the trading room on a piece of paper. More or less, I forget exactly what the connotation was, but let's just say when it hits the fan, 1, widen markets, 2, shrink sizes, 3, raise vols. And so what happens is that's really your best defense. Now we got, we could always override the system and just sort of say, boom, we're cutting all the sizes, or boom, we're widening all our quotes. It was a bit more dynamic than that on a regular basis, but when it hit the fan, that's what we would do. And that is, I've said before that liquidity is inversely proportional to volatility. Right. And when things are not particularly volatile, you see very tight spreads and large bid-ask sizes. When things are moving around dramatically and it becomes very hard to establish, you really don't know what the prices are, or effectively you're getting, you see the lights and you realize, it's not somebody on a bicycle, it's a freight train coming at you. You've got to try to get out of the way. And if you're doing this across, thousands or millions of products, you have to do it systematically. And so what people do is they widen their prices. And if you're still getting hit on one side or the other, you widen them some more, or you change your vols, or you've got to get out of the way. But that's how you do it. But if the market making community is acting in this manner, which is rational, that's when you start to see prices widen out. Bids and asks shrink, bid ask sizes shrink, and unfortunately, there's a certain feedback loop to that because those who typically provide the liquidity are providing less of it, which makes
when
it
everyone wants it
harder. Yes, it's harder for people who want, and it's very hard and expensive for the people who want to consume it. So they're willing to do more outlandish things. If you're trading, I'm going to call it on a voluntary basis. You're putting out bids and asks. And you're trading against someone who's got a margin call, meaning they're trading on an involuntary basis, or they're getting a tap from their clearinghouse saying you better lighten up, whatever. Then it doesn't matter where you think the right price is. It matters where the other guy is willing to trade, and so you have to be very nimble. But that means that to keep it that nimble, that's part of why you see. That's why you see markets move around. And now you see it today. I think some of the moves, let's say just in the markets that would be eye-popping, that would have been eye-popping a month ago, we'll do in 15 minutes. The SPOOs rallied 25 points, more or less, from 345 to 352. We rallied about 20 or 25 points in the SPOOs today. That would have been a headline.
It's
Steve,
yeah.
Steve, I have a story to tell you about that. I was sitting there one morning when they were like in the height of the craziest part about it, and I looked at my chart and I said, "Oh, the S&P it's in this range all morning, like before the market opened, basically from 7 o'clock till 9:30. It was in this range, and I thought, oh, it's in a nice narrow range, and then I realized that range was 150 handles.
Yeah." Yeah, because it gets compressed to fit in whatever your little graph is. I've got like I've got all these like couple of inch sized graphs on my screen, and you lose context. And I was like, oh, yeah. So today I'm looking at it, I'm like, there's a nice little rally into the close. Like, wait a minute, hold on, hang on. We were down over 2%. Now we're down like 1.4 or so. This was in a matter of minutes. Like this is an eye popping move. This is why.
Yeah, so Steve, I wanted to get to your article in a moment, but I wanted to just ask the question because I'm sure a number of our listeners, especially a lot of them are newer retail investors that are now having to deal with what they were used to was a nice liquid calm options market with tighter spreads. Now they're not finding that anymore, and I think you wrote a recent Barron's article on this, right? And just in terms of how does one approach dealing with these fast markets where the liquidity that was once there is not there the same way? What advice would you give to those retail investors?
Well, thanks for bringing up the Barron's column that I wrote. That was I think it was the March 16th issue. If anybody wants to look it up, but basically, it's your job in this environment to think like a market maker, and you want to be the liquidity provider. And here's how I'm going to discuss it this way: when liquidity, when markets have tight spreads and big bid ask sizes, it really doesn't cost you much to consume liquidity. And by consuming liquidity, I mean crossing the bid ask spread. So prior to this, if you were trading, spiders or cubes or something like that, pretty much any on-the-run option was a penny wide, and the bid ask was sufficient for any retail person to get their trade done with 1 penny market impact. Big deal. So you do your trade and you move on. Now, as you see spreads widen out, and particularly in names that are not spiders and cubes, but let's say your next tier down, big high number high dollar stocks or just everything. The spreads have the quality's gone a little bit. You don't want to be chasing that market because that means you've got to cross a bigger bid ask spread. You've got to be paying a nickel or a dime or more if you want to be buying on the bid or selling on the offer. So the tactic that I was saying is, first of all, if you normally like to trade a 10 lot, trade a 5 lot. Okay, remember, shrink sizes. Widen your quotes. So that's widen your quotes. What you want to do there is, if you don't really want to be the guy crossing the bid-ask spread, unless you think that there's something going on that you absolutely have to, hit a bid or lift an offer. Don't stick out a limit order. Odds are someone's out there lurking around. Going back to the original thing that you said about NASDAQ early on, you could be 3/4 a quarter and you'd stick out a 7/8 bid and no one would hit you. People are hitting you. The algorithms now are sensitive enough that somebody's algorithm may be set up not to display an order that's priced inside the market, but will hit or lift an order that occurs there. So right. Those would be the two tactics. So it really all comes back to that. When liquidity is scarce, you really don't want to be in a position to consume it. And you want to be in a position where you can provide it and get paid for it. And the way that happens is by using limit orders, by trying to trade inside the book, by not chasing. And that I think is a very important lesson for retail and institutional traders.
So, Steve, what I wanted to just kind of build on that, and maybe you can explain whether this is the right way of looking at it, but I always say the Theo price of an option is somewhere in the middle of the spread. It's generally a rule of thumb, is it not? And so what you're looking for is to find out where the algo will pick you up off of that zone, right? So if, let's say, it's a 20-cent spread, you're trying to essentially feel out with the 10-cent middle somewhere off of there where the actual algo will pick you up. There'll be a market there, even though they're not going to post that bid. Is that a fair way of approaching it? Like, am I describing it right, or how would you describe it?
Absolutely. What we would do, and again, I can't imagine we were unique in this thinking, and what you've described is what we did. We for every one of those prices that we put out there was a theoretical midpoint. That was the fair value. And we would then, quote for a certain, based on a whole lot of parameters, we would then post a quote around that midpoint. Not everybody's midpoint is the same. If that was the case, no one would ever trade with each other. But basically what we would do is we would, as I mentioned, we wouldn't necessarily go out there and say, let's use your example. It's 20 cents wide, and let's say the 10 cents, 30 cents, and the midpoint is 20 cents. And let's say we agreed that the midpoint is 20 cents. If someone were to offer at 20 cents, I may or may not take that. Depends. Depends how much I really want to get it. Someone offers at 18 cents, 17 cents, 16 cents. Odds are we're going to take it. And our system would be programmed to do that because we'd say, all right, it's worth 20 cents. We could buy it at 15. Well, you've just saved yourself a nickel in that situation if you've put in your offer at 15 cents. You may not want to cross the bid. You may not want to cross the midpoint of the bid-ask spread. It's tough to do when markets are moving quickly to really establish that. But that's the theory. Is there are algorithms out there that they may not want to tighten the spread, but if they see something they like, they will actually go hit a bid or lift an offer inside it.
Right. So thanks for those insights. So I want to actually jump into your article. So I'm sharing on the screen here an article you posted on Traders Insights, which is on the IB site, and you wrote this piece and it says the VIX is too darn high. And then you said, no, it's not. And what's interesting is because you really touch on the fact of how volatility really is priced into options, and the idea that while we always keep looking at things from an annualized terms, that volatility is priced on a daily basis. And so why don't you take us through the spirit of the article and really share with all of our listeners kind of where we are on this volatility. Like, I mean, with the VIX pretty much stuck in the 50s here for weeks now. I mean, how do we size up the volatility in today's conditions?
Well, I'm gonna mention something, and I hope the listeners keep this in mind. Get very good at multiplying and dividing by 16. The rule of 16 is something that every option trader should know, and what that does is when you look at a number, and you see almost every system does this. It'll show you your implied vol or the historical vol, and it'll do it in a number that's like a 30 or a 40 or a 50, and that's an annualized number. That number is essentially meaningless because every option you trade, I forget what the number is. Probably 80% of the options traded have an expiration less than a year away. In which case, that calculation doesn't really hold a lot of value. What does that mean? It's going to move 40% over a year? Well, not really. What it means is that if you take the daily moves, which is really where historical volatility comes from, it's the dispersion of the daily moves around the mean, the standard deviation of those moves around a mean. So stock moves up 1% one day, down 1% the next day, up 2% the next day, down 2% the next day. You do that over time, and you'll say, and I'm oversimplifying, but okay, moves about 1.5% each day. What Black and Scholes did early on, and it's groundbreaking, but this became the industry standard, despite the fact that it's not the most useful way to do it. They didn't know they were breaking ground. That 1.5% move was converted into an annualized volatility. And the way you do that is to go back and forth between annualized and daily. You divide by the square root of business days in your calculation. Thankfully for everybody, that number is just about 16, because 16 squared is 256. In any given year, there's 250, 252, depends on the year, depends on whether it's a leap year, but 250-ish business days a year. So the square root of 250 is awfully close to 16. So for the purposes of this, we're just going to multiply and divide by 16. So going back to the example I gave you, where we said, all right, well, this stock, if you add up all the 1% ups, 2% downs, et cetera, we average out to 1.5% a day over the measuring period, multiply that by 16 to get it into annualized terms. That's 24, 1.5 times 16. And all of a sudden that's where that number comes from. So what you have to do is actually deconstruct it and move it back to a daily number. So you see a 24 and you say, all right, well, that's we're pricing in 1.5%. It's a 32, we're pricing in 2%, et cetera, et cetera. And so the crux of the article was, a lot of people were reaching out to me, some in the media, some just individuals saying, oh boy, the VIX is at 70, 80. What does that mean? That's just too high. And at that point, the market was moving, call it 5% a day. And when I say 5% a day, a lot of times historical volatility is measured close to close, but the more relevant number is sort of the intraday range. That's much harder to come by. It's more of a professional calculation. But if you're hedging gamma actively, you're more concerned about the total high-low move rather than close to close. So that brings you into a whole other set of calculations. But what that would mean is on any given day, we were moving 5%. We were close to close 5% in many days. Intraday, we're 5, 6, 7, 8%. Well, let's do that same calculation. 5% times 16 is 80. 80 VIX. That doesn't seem that high, does it? Now, we're starting to see the VIX come off as well it should. It's really hard to sustain 5% moves. And the VIX very specifically is meant as a 30-day look ahead. So it's really the market's best estimate of where the vols are going to be over the next 30-day period. So in many ways, it was too high at 80, and we kind of knew this. But from a mathematical point of view, it wasn't that outlandish. And so now you're seeing the VIX, 50-ish, which implies, again, little over 3%, 3 times 16 is 48. Does 3% seem outlandish to you over the next 30 days on a daily high-low close idea? Not necessarily. So that's the logic behind it. And this is how you should be thinking about this. It's also very useful, let's say, around earnings, particularly with weekly options. But you can take a look and say, all right, well, geez, this implied volatility is sky high. It's an 80. Well, you go back and look and see that this stock tends to move 5% around its earnings and go, oh, wait a minute, that's about where it should be. And so this is the way you start to think about it. And so it's very important to think about the option, the implied volatilities that you're trading at in terms of the relevant holding period or the right time to expiration of the option. So while it's really kind of meaningless to think about it, a vol as a 40 when you're talking about an option that expires in 3 weeks, it's a lot more relevant to think about that as, call it 2.5 over the next 2.5% daily moves over the next few days. And so over the next period, whatever that is, 2-3 weeks, that's a much clearer way to think about whether that option is rich or cheap.
Right. So, Steve, it's Kev here. The great explanation. I think it's terrific. And one of the things that, that I think the market didn't realize, and I have a theory of why they didn't realize this. But they didn't the VIX, people kind of instinctively looked at it and said, oh, it's 80. That's too cheap. Not realizing that it's actually moving like 100 or whatever it is based upon that week or two when it was trading 5 or 6% a day. Let's do your math. What is 6% a day on a VIX? What should that be? Times 16?
96.
So it's 96, right? So
yep.
at that period, there was literally a week when we were trading there, and the VIX was trading like 75, and it was trading below. So actually, the VIX was below the realized vol that you were experiencing. And I actually have a theory, and I'm going to put this out there, and you can tell me if you think it's correct. On the way up in terms of volatility, there was a lot of people, or not a lot, but there were some that had bought tail risk in VIX products. The famous Mr. 50 cent guy that goes out and buys VIX options. I think that on the way up, when he was selling those things that he had paid pennies for, 50 cents, and he was selling them for $5 or $8 or $10 or whatever it was, he was actually supplying the market with VIX that they needed. And so it was actually keeping a lid on the amount that people were willing to buy. So there was a supply of options. Like usually there's no supply of gamma in those kind of events. And there was, in this case, a supply of gamma, and therefore it was trading below realized. Do you think that theory holds any water, or do you think it's just blowing smoke?
I think it's not wrong, but you also have to remember how VIX is calculated. It's a 30-day look ahead. It's using a blended series of options, and it's a very complex calculation. But it's the SIBO's best way of saying, all right, we're gonna try to figure out what the vol will be in 30 days, what the realized vol will be in 30 days, not what it's going to be today. So what the market was pricing in to a certain extent, let's say when it was at 75.80, even when you when you look at it if you look at it on a daily basis, we were realizing 96, but the VIX is at 80. But the VIX is looking ahead. So it's not just using this week's options, it's using options out a month. And the VIX got into a serious amount of backwardation. And I think I did supply that chart. And so what the market was saying was, all right, we're moving 6% a day. But if we start to project this out 30 days, are we going to be able to keep moving 6% a day? The market sort of took the view, no, that's a bit much. We're going to say maybe 4 to 5% a day, which over time, as we start to average these things out, is becoming a fairly appropriate number. And that's why the VIX would undershoot in a time of extraordinary volatility.
Right.
So,
sorry, Patrick, can I ask one more question?
Yeah,
I've seen another professional kind of hedge guy, and he argues that implied volatilities are slow to move up and slow to move down. And therein lies the real arb for professional traders. What do you think about that statement?
I think they're very fast to move up and slow to move down. It's like gas prices. Think about when the price of oil goes up, and I know that's a kooky thing to talk about now, but when the price of oil goes up, the price of gasoline goes up, at the pump, they raise the price immediately. On the way down, they're fairly slow to lower it because A, they're long whatever they have in their tanks and don't want to sell it at a loss, or B, they figure, well, if we bring it down slowly, the market can bear whatever it bears. And I think there's a certain amount of that with volatility among market makers. It's basically, it goes up very fast, but on the way back down, depending if you have inventory or not, you're not necessarily looking to puke it out.
Right.
So it tends to move down a bit more slowly. And I see on the screen you've put up the VIX chart that I supplied. So if you'd like me to talk about that, I'd be glad.
Sure. Why don't you go ahead? Yeah.
Okay. So there's a lot of lines on the chart. What this has here is the VIX futures curves at various snapshots in time. And for those of you who may or may not be aware, there's an active futures market in VIX, which is used by again, institutions to help hedge themselves. And basically, I'm going to work my way down the chart. Actually, won't work completely down the chart because I'll start with the green line, which is in the middle. And that was the reading of where the VIX futures were at, when did I do? Probably about 2 o'clock today. I prepared the chart. And so you can see that the VIX is, the closest number, the first number you see is about 50. And that's where we saw it. And then you see it sort of sloping down, let's say 40, 45, 40 into the next few months. That's the phenomenon I was talking about with why VIX wasn't necessarily wrong, even at its highs. But I did include, as we work our way down, March 17th, which was the day before the March VIX contracts expired. And that's very important there because I think the system, because this move happened so quickly, the system was really gummed up leading into March expiration, which is why the lows, at least so far, which have held, were right around March expiration, because people couldn't get out of contracts. If you had all kinds of dislocation, you had all kinds of margin calls. People were constrained, so it was very hard to roll, which also meant that you were stuck with these contracts that you might have normally tried to roll out of, but you couldn't, and they were expiring. And guess what? Because we're moving so much, strikes that normally would have no extrinsic value to them had a lot of extrinsic value to them. Let's say $10 out of the money puts or calls and spiders, which 2-3 days before expiration would essentially be either be zero or fair value, intrinsic value. They had gamma to them. They had some sort of extrinsic value to them. And what you started to see was that people were really tight in there. And so that peak, one of the peaks, it wasn't the absolute peak, but I included the March 17th as that was right before the last VIX futures expired. And I think there was a big sigh of relief, first in VIX on Wednesday, because they settle Wednesday morning, and then the Friday the 20th of expiration. We did actually sink lower on the 23rd, but that was pretty much at least the lows for now. And I think that was because the system was getting its bearings. You had a lot of open interest just vanish, and with all that open interest vanishing, that meant that along with it went margins on all those options, or haircut, however you get charged. But there's capital that's required to maintain all those positions. I believe the number was about 20% of open contracts expired, which was a big expiration. So and Steve, as a result, the system was able to contract and catch its breath.
Right, Steve. So you're bang on, and I was going to actually take it there, and you took it there without me asking. But like that quad witching March expiration was a big one. I mean, I remember some quants like Charlie McElligott talking about there being over $500 billion of delta deep in the money puts that were on dealer books that at these high vol premiums were so hard to roll, and they had to all be unwound. And the fact that dealers had to, and you can speak to this if I'm right in the way I'm describing it, but dealers obviously have to be hedging all of this. And as it came and got all rolled off on that March expiration, then all of the volatility that dealer hedging was contributing to it, now a lot of that has been taken off, and that's why volatility was able to back off after that March expiration. Am I describing it right, or how would you?
Yeah, yes, that's it. And one of the things about all those deep puts is if you're long deep puts, okay, first of all, if you're short deep puts, you just got to wait until someone exercises them. If you're long deep puts, it behooves you to exercise them usually, because if they're 100 delta puts and way deep in the money, normally what you would do would be, okay, it's cheaper just to take the position off your book because you're long this deep put, which is a short position, and you're presumably long stock against it, 100 delta, and boom, off it goes, because there's no intrinsic value to the call when you think about put call parity. In this case, there was value to a lot of those calls, so you would not want to put in an early exercise notice on them. But what that means is that ties up a tremendous amount of capital, because you've got this deep put and this stock, and they're moving around, and somebody, and whoever's on the other side who short those puts is kind of hoping that you unwind it, because they hopefully from their point of view they're short the put and short the stock as a hedge, which has its own haircut issues, and these positions would normally be getting rolled or just early exercised. Early exercise of puts is that's something dealers do all the time. Every day we would exercise anything that was going ex-dividend and exercise the calls, but we would also exercise puts just to clear the books. At some point it's a waste of capital, but it wasn't, because there was gamut of these things. There was still extrinsic value. So that's exactly what it was. We had all these positions that either couldn't be rolled or were not prudent to exercise, because you'd be giving away option premium if you did that. But as a result, kept like glued up people's books on both sides.
Right. So actually, I wouldn't mind you speaking to that, because a lot of our listeners do like things like covered call writing, and many of them tend to favor blue chip stocks, which have these dividends. And so you're always dealing with the early exercise issue once there's intrinsic value in these over any dividend periods. What rules of thumb could you offer our listeners when dealing with option overwriting on stock, as to as a rule of thumb, when should they make an adjusting trade, and because they're likely to get hit ex-div? What is the rule of thumb that you could leave them with?
Well, when we would make a decision to exercise, the rule of thumb is if the put is worth less than the exercise, and this goes back to put call parity. So you're really only going to want to ever exercise an in the money call. So one of the things you don't want to be, if you're an individual who does not want his stock called away, is if you're crossing a dividend payment, you really don't want to be selling an in the money call. You want to be selling an out of the money call, because that reduces the odds that you're going to get called, because there's no incentive to call an out of the money call. And what you want to be doing is, even if the stock, let's say had the good fortune of the stock move up, so that the call that you shorted is now in the money, you can decide to try to roll out of those if you'd like. But the way to tell if you think it's an exercise is basically you look at the put side. This goes back to put call parity. And if you're not familiar with it, it's a pain in the neck to explain. But it's really easy if you see it. The put plus the stock was the call and the strike. Look it up. But basically, what you want to do there is if the dividend, the rule of thumb is let's say it's a stock and it pays a 20-cent dividend. If you look at the put side of whatever strike it is, and that is under 20 cents, odds are that call is an exercise.
Perfect.
And that's the way you want to do it. So you want to preferably avoid doing rights in dividend months. But if you do feel like you want to do it, you want to try to make sure that it's going to be an out of the money call, not an in the money call, or else you really do expose yourself.
And if you're in the money, you want to be rolled. You want to be rolled out far enough where the time value is greater than the dividend, so that way there's not the incentive for that early exercise, right? So you don't want to be holding front month cover calls. There you go. I remember you telling me this over a beer when you were up here in Canada, but I wanted them to hear it from you directly. But it's good advice. That's a great
Patrick,
way of approaching.
That's shocking that you guys are drinking beer. So unlike you.
Hey, by the way, are you drinking beer right now, Steve?
Yes, I did. See, the last time we did this, I was in my office and I couldn't crack open a beer. It's not something we do. Now that I'm sitting in my home, I have a Two Roads Workers' Comp Farmhouse Ale from the Two Roads Brewery in Stratford, Connecticut, just up the road.
Nice. Well, listen, then we're going to have to get them to sponsor our show one of these days. That sounds like a good beer.
It's a very good beer. And, people don't think of Connecticut as a worthy tourist destination. Well, obviously nobody's going anywhere right now. But just up the road from Stratford is New Haven, which has, I'm going to argue, the per capita, the world's best pizza. I'm always open for a pizza on your road trip. So,
wow. That's some fighting words. The world's best pizza. Do you follow Dave Portnoy with his One Bite Everyone Knows the Rules?
I don't follow. I'm familiar with it. There's various pizza bloggers. I'm not familiar with him specifically, but trust me on this one. New Haven punches way above its weight in terms of pizza. Sally's and Pepe's and.
I'm going to go look it up because I think he did drive out there, and I think he was talking about that because I've heard that before. That New Haven has great pizza.
Well, Kevin, we're gonna have to go and actually just find out for ourselves. I think.
I actually sounds like a good. You know what? We should have the third Steve Sosnick kind of market huddle experience, and we should have it at a pizza place with some beer. That sounds like a good plan. Steve, while I was listening to you, sorry, go ahead.
No, I'm more than up for that one. Absolutely.
Okay. While I was listening to you, you're giving us some great advice in terms of options, and obviously with many decades under your belt, you've learned a lot on your own. But I kind of often find myself getting asked questions about what's the best book, what's the best resource for people that want to learn more about options. Do you have a favorite book or a favorite website?
I got to admit, like in terms of the type of the best book, problem is I read these books so long ago, the Bookstaber book and the Blair Hull book. These are oldies. So I really haven't kept up on like the current stuff because more, my kids are actually urging me to write one, not to read one.
You should you should do it.
Yeah, and Steve, tell them just to take the Big Picture Trading Options Masters course.
That's
there you go. The shameless plug. The shameless plug.
No, but you know what? But Patrick, I've followed your work for a long time, and I know that what you're doing is solid and great, and a great resource for individual investors. We're trying to work on some of the stuff on our own, and I've actually been rewriting our internal options course because I thought it can use a lot of improvement. But in the meantime, until the Interactive Brokers learning course, you can still learn a lot on Interactive Brokers Trader Insight, I might add. My shameless plug. I think something like Big Picture Trading is a great resource, and I'm not just blowing smoke because you're nice enough to talk to me. It's the kind of stuff that these are things investors should be doing. And I wish I could say, this is the best one, but I really haven't kept up on all, let's say the good intro to option books, because that's my project is to write one.
Right. So for those who don't know, the Bookstabber book is Richard Bookstabber, and it's called Option Pricing and Investment Strategies, and it's from 1987. And I did read that one as well. It's kind of the Bible. The other one that I really liked, and I think it's the same era as the Sheldon Natenberg.
Natenberg is the other Bible. Yep. I forgot about Natenberg.
And that's the other one. Let me just get people the names of those. Now, we are showing our age. Option Volatility and Pricing. And I always tell people that that's one you should go to. The other thing that I always find when people have trouble understanding options, I don't know if you feel the same way, but I always tell them to imagine they're a market maker and they were forced to hedge the position. And then they understand what the risks are in terms of their how that thing's going to move. And for example, like until you go and short and like a long dated option and find yourself with a big, huge dividend change, you don't really understand that risk. And so this is one of the things I always tell people is pretend you're a market maker and watch how these options move under various scenarios. Have you ever what do you think of that idea?
I love that idea because that's the way I think. I mean, that was, and that's one of the stuff I've been one of the lessons I've been trying to impart now that I'm on the side of the business where I can, talk about this stuff and impart some of these lessons. That's absolutely the way to do it. There was an old saying, and I'm probably going to have it wrong, but it was something like, being short 10 May wheat contracts is worth a year at Harvard Business School or something of that effect. And you know what?
Although in these days it's probably May VIX. That's what you should probably use.
Yeah, exactly.
Yeah.
But there you go. I mean, and so you put yourself in the shoes of, okay, come to the table. This is not to say that individuals can't trade options intelligently and profitably. You can, especially in these kind of markets where there's a lot of room and nobody knows where the right price is. So your guess is probably okay, but as long as you keep your bets manageable and your investments sensible. But one of the things is that on all this stuff, somebody's always doing it better, and that was one of the lessons I learned as a market maker. Going back to the comment about negative selection, whoever was trading with me, I had to assume they knew more about they had to know more about what they were doing than what I did. I didn't do the fundamental research on every company we made markets. We made markets in over 1,000 companies and company options. Like, who knows all this stuff? And so you had to respect the market. So when you think in terms of what might I be missing, or if I'm going to price this thing out, what am I looking for? What should I be thinking about? That's a great way to think about it. It's absolutely. I got a footnote when I use it again because I think it's a terrific way to think about it.
Well,
so,
thanks,
Steve. Let's talk to you. You prepared a couple extra charts here, and we're running a little long on time. So why don't we just go through what's on your mind here, and what are we looking at?
Well, one of the ones I provided here was the VONG versus the VONV, and you've heard a lot of times about. You've heard plenty of people talk about like the spread between growth and value, and I think U.S. investors, and I say this is the market collectively, sort of worshipped at the altar of growth stocks, and looking at this chart, because it's normalized to a different number, the value is actually on top and in the orange line, and the growth VONG. I use just two Vanguard ETFs because they basically take the universe and divide it into these two neat categories. And you can see over time, the growth one really caught up to the value one. Actually, if you look at it over a better time period than I provided, you would actually see the growth really outperform, and then boom, they both really came apart. But you could see the spread in the bottom, in the middle graph rather, of how the VONG started to outpace. That's just a mathematical spread. The VONG really began to outpace the VONV. And even with this recent decline, growth is still trading at a huge premium on a historical basis to value. And so you really have to think as an investor, do you want to be going back into the stuff that's been working, or do you want to go back into, or you want to try to look for deeper value? I think a lot of that has to do with your mindset on whether what we're looking at is temporary or longer term. If it's temporary, I can make the argument that you want to just go back into the stuff that had been working before. If you're more long term about it, you may want to be in something that's a bit of a deeper value and say, all right, well, there's a lot more air that can come out of the growth stocks than out of the value stocks. So there's no recommendation in here. It's more of a thought process. The bottom graph, by the way, is a great visual. It's a correlation, and you can see how over time the correlation's been between 85 and 90, but in a sharp decline, correlations always converge. So you can just see that spike in correlation.
That's everything
thrown out.
Everything but the dollar has a correlation of 1 during a crash. That's
absolutely.
That's where you throw diversification right out the window. It's
Absolutely.
Diversification only works until you actually really need it to work, and then it stops working.
There you go.
and then you have the spies here. What are we looking at?
Same sort of thing, same kind of mentality. I want people to be able to think in terms of relative valuations. Again, you see that SPY, started off, again, it's a sort of the weird normalization. So the SPY being the white line in the top graph really caught up to the Russell, which was the orange line in the top graph, meaning the SPY completely outperformed. And you can see that in the middle graph, how just SPY just continued to really just blow right past IWM in terms of, this is again, in terms of the raw number, SPY minus IWM, it's arithmetic, but you could just see SPY tear ahead, and it kind of got brought back to earth to a certain extent in the last couple of weeks, but you're still seeing, again, we're not back, let's say, to parity, and there, again, you have to start to think about, do I want to be investing in the broader, non-correlated, smaller companies that are in the Russell versus, let's say, the big cap darlings that are in the SPY? This one's a more interesting one because, quite frankly, at least in the U.S., it seems like although there's been a lot of money thrown at small businesses, it seems that it very much favors the big ones right now. And so that one's a bit murkier as to where do you really want to be placing your bet. The Russell is always perceived as a bit more economically sensitive, and when you're looking at an economy that could be in some severely impaired for some period of time, you have to decide, is that where you want to be?
Yeah, it's interesting. I was noticing when you overlay the Russell over, let's say, the Euro stock, they actually had the same percentage drop in reaction, and the S&P and NASDAQ were much quicker to rebound and actually dropped less on a percentage basis. So it was interesting that the U.S. small caps actually behaved more like some of those international markets. I don't know whether you have any opinion on that, but it's just a weird observation anyway.
Well, again, the SPY is much more multinational, and the perception is that Europe is sort of viewed as this laggard, and so if you're viewing a laggard there and a laggard potentially in terms of small cap Russell type of stocks, they would react fairly similarly.
Right. So I want to leave you with just a quick plug. I know that Interactive Brokers was working on IB Lite. And how are things going with that? And how is the zero commission world how are you dealing with that over there at IB?
Well, we actually were less impacted than others by this. I can't go too much into our economics, so I really just have to tell you what the party line here. And basically, commission revenues were a smaller percentage of our revenues than they were at other competitors, because we do our own clearing, and so we tend to get a lot of our revenues in the sort of stuff that isn't affected by a zero commission world. I think that there's been some appeal to what we're seeing because again, I can state this for the record. Our customer equity was up 9% last month, and this is a public number. I'm not giving anything inside here. So for our customer equity to be up 9% over the past month, either our customers are really smart, or our platform is getting new customer business in, and because that money's got to come from somewhere. You'd expect our customer equity to be down more or less in line with world markets, which would be about 20%. So from that point of view, I all I can do is shade in the pictures because I actually really don't have any insight into anything that was not publicly reported in the most recent numbers. But I think IB Light is resonating with people. Something is resonating with people because our customer equity would not have been up in a down market unless something was working.
Right. So I want to do a quick shout out. Now I know you post a lot on LinkedIn, so anyone that wants to follow your stuff on LinkedIn, you've always got something going. But you're just recently in the last little while been getting onto Twitter, and so just make sure that all of our listeners that are on Twitter, make sure you give Steve a follow at Steve Sosnick on Twitter, and let's build up his Twitter following so that he posts more on there, right, Steve?
Thank you. Yeah, build up. It's not just to build my ego. The more feedback I get, the better. I'm happy about that.
No, so make sure everyone go out there and give him a follow and give him a plug, and let's get him more active on the Twitter community. But anyway, Steve, is there something we forgot? Anything you wanted to mention? Any last words? Any last little thing you want to leave us with?
No, I mean, one of my goals in Twitter is to be as big as Kevin, but I just in general, no, I mean, boy, what else can I say? I've been yammering for an hour, and I certainly hope we got to most things, and I hope I left people a little bit smarter and well prepared is all I can say.
Steve, it was a pleasure having you. Those little tidbits of insight just can't be found by regular people. It's your many decades of experience in the option market really shine through in a time like this. So thanks for taking the time out to speak with us, and we look forward to having you back on, and hopefully it's at your place with some pizza and some beers.
I'm looking forward to that one. Sure.
All right.
Thanks again.
Thanks a lot,
Take
Steve.
care.
Take care. See you guys.
Lena, hop on.
Hello.
It's time for the rest of the show.
Yes, it is.
I'm so used to calling you on to tell us who the beer sponsor is, and we had to suspend this because we're having a channel of distribution problem with the
distribution problem.
Social distancing beers right now.
Social distancing is preventing us from getting the beer sponsors to beers to all of us, so that we have no way of judging this. So we have a lineup of beer sponsors waiting for us to lift this ban. So we're drinking the whatever's in the fridge beers.
I'm running out of beers. I don't know about you guys, but I'm getting low.
I don't even have any more beers.
What are you drinking?
I'm
Lena?
drinking coffee with Baileys, or you can call it Baileys with coffee.
Baileys, a pretty thick helping of Baileys, or is it just very light?
Yeah, I would say it's pretty much like a Baileys soup with a splash of coffee. It's keeping me alive right now.
That's all right. What are you drinking, Kev?
Well, it's desperate times when I'm drinking a fruity beer. I'm drinking Fruitbot 4000.
Oh, what? I remember that one.
Oh
no! That's all I had.
How are you? Okay, I want to see a reaction when you open this.
Desperate times for desperate measures.
Do you remember what it tastes like?
I do, and I know he's not going to like it.
I know what it tastes like too. I remember.
It's hard to forget, and that was from New York, right? Like
yes, it is. It's from Brooklyn.
When I was down there, I grabbed it.
So what about you, Patrick? What are you drinking?
I've got the Canuck Pale Ale from the Great Lakes Brewery.
Oh, that sounds good.
Mm-hmm.
Yeah,
you know what? We should do a little incognito kind of transfer there. Maybe we sneak out and just see each other in the cars and open the windows like cops at passing and like donuts,
and then just have like Lysol wipes to wipe down the beers to get all the.
Well.
Anyway,
we both live clean lives, Patrick. I know we'll be okay.
I think once the social distancing thing is over, we should have a kegger.
Oh,
there you go. Good idea, Lena.
Yes.
We'll invite all of our huddlers. Well, we'll have a kegger.
Yeah.
Oh my God, what a great idea!
As long as it's not this Fruitbot 4000 I'm in.
Oh, did you try it?
Yeah, it's terrible.
It's fruit punch and beer.
There you go.
Okay.
All right, so Kev, give us a little bit of legal shit.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include ghost theta decay, mobilizing boredom disorder, and or swamp feet fetish. I know that last one has nothing to do with the markets. I just like it.
It sounds really gross.
All right.
It does sound a little gross. Okay.
All right. Let's get Barton on.
Joining us now is Barton Wong, who's well known on the Twitter sphere as Barton_options. He's been on the show before to chat to us about gamma and quantitative easing and all sorts of stuff like that, but he's actually become a little bit of a virus expert. So what we've done is we've wanted to have him join us to talk about the virus and what it might mean for the markets going forward. Barton, thanks for joining us today.
Hi, Kevin. Hi, Patrick. Thank you for having me again.
Barton, you've been on this story really early. I noticed that you were talking about this on Twitter. Maybe it was even December or January. Can you talk to us about what interested you in it and why you became so involved?
Yeah. So I got the first alert on this pneumonia and virus around December 30th. I have lots of family who live in China, about 250 to 300 miles away from Wuhan. So at the time, I alerted them they're in their 60s and 70s. So I alerted them and just called them to be careful. But pretty much everybody laughed me off, even in China at that time. So I just kept it quiet and did my research on the background. Actually, until you, Kevin, I remember you wrote an article for Macro Tourist around January 15th or maybe 17th. And we were in a chat room, and you were asking questions about this, and I saw that, and I realized, oh, okay, this is getting bigger, and people who don't have family who live in China started to pay attention to this, and then I started to basically dump all my research on Twitter, and then this thing exploded in late January in China, which was a existential crisis for me, because I figured at that time, without any treatment option available, some of my family members probably only have a 30 to 40% chance of survival in the next 6 months. So I just went 100% into research on any treatment options, preventive options. I actually got them to buy equipment like oxygen concentrator at home, because in Wuhan, in the first 10 to 15 days, is pretty much like the situation in New York right now. A hospital actually run out of oxygen.
Right.
And people who were hospitalized had to bring their own oxygen concentrator. If you don't have oxygen concentrator, you pretty much just die in a couple of days. So that was things I was pretty keen on to get a hand on. And then fortunately, there were some treatment option later on emerged, and there seems to be quite effective. So it's not an issue right now.
And so, Barton, your actual background is somewhat related to this, right? In terms of your educational background, is that correct?
Yeah, I have a PhD in physics and engineering, but there is a mild immuno disorder in my family where people get a very mild kind of cytokine storm triggered by exercise. So I've been researching this topic for more than 10 years. Dietary nutritional support to avoid having to take meds on this. But this virus is really like a cytokine storm at the massive scale if you got into a severe case. So a lot of the things I researched before pretty much just apply to this situation and try to avoid to get into a severe condition in the first place.
Well, Barton, just like all your other stuff that you researched, the insights you came up to were just illuminating, and you were very helpful for a lot of people on Twitter in terms of understanding this. Why don't you tell people what you're thinking right now, and specifically how it relates to the different age groups? Because you mentioned earlier that you think that not enough people are talking about this fact that different age groups are going to be affected different ways, and what this might mean.
Right. So I guess in order to understand, or in order to see how this the spread of COVID-19 may affect the market, it's important to understand how quickly this would affect the population in the U.S., in Canada, and in Europe, other areas. And you see a lot of people quoting the number called R0, which is the base reproduction number. But from what I understand right now, for example, in the US and in Canada, different age group respond very differently to the virus, not just in fatality, but also in people's attitudes towards social distancing. So I think this R0 is very different for different age group and also in different geographic areas. In big cities, people react differently from in smaller towns. So for the age group, I think right now, the fastest spread of the virus is among family with kids. So people in their 30 to like 50 with kids at home between the infant to high school students, that kind of age, basically 0 through 18 years old. It is really hard for people to do social distancing at home. So essentially, you always get into a family cluster situation. And for kids, as far as I can see here in Austin, I just don't see much social distancing going on. They're not going to school, but they still go play soccer together or hang out together. So the spread between kids is pretty hard to prevent, and the kids don't show very severe symptoms at all. So spreading from kids to their parents, I think, is probably the highest R0 right now. Even with the social distancing measure, probably the R effective is still around 3 to 4, and that's the earliest. This group probably get the earliest impact. Probably, I would say 10% to 20% of the population in the U.S. and in Canada should be affected by the end of June.
Wow. Well, here in Canada, I know we've gone, or in Toronto at least, we've made it so it's kids can't go to the playground. You can get a fine of up to $5,000 by being in the playground. So we, I think, are aware of that and trying to influence that. I'd actually like to talk about going forward, different paths that this might take. And one of the things that I wanted to avoid on this kind of interview was to not just talk about, the virus is going to be so bad, blah, 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 you better sell everything because the world's ending, which is definitely one of the possibilities, but it's not, it's probably not even the most probable possibility. So why don't you walk us through kind of, let's say a worst case scenario, a most likely case scenario, and a best case scenario. And then maybe you could, at the very least, give us your opinions about what the probabilities of those three different scenarios are.
Right. So so going back to that age group topic, sorry, let me try this one more time. So besides the families, like people in their 50 to their 65, these are the people probably most protective against themselves, and these people probably the last to be infected. And then people above 65 are also very careful if they live at home. Nursing homes is a different matter. So I think in the best case scenario, we're going to see an initial peak among family with kids, and then a long tail towards older people or people in their 20s and 30s who don't have kids yet, but they're married, so they're more easier to do social distancing. So in the ideal case, if the current policy that's in place, being held constant, then we should see a relatively long tail or a second peak, but it's not as tall, not as pronounced as the first peak into the summer and into the fall. So the market impact, in my view, really depends on how the policymaker would respond to the spread of the virus. And I see several different options, as you mentioned earlier, how we can proceed and how that impact the market.
So, Barton, just to understand, you see no chance that it's going to kind of die out and that we're going to be living a fairly normal life in a month or two's time, right? Like, you think this is with us for until we can get a vaccine, and therefore our kind of social policies or social kind of behavior is going to have to be affected that whole time, and then most likely also our kind of work environment.
Right, I see, exactly. Because of the contagiousness of this virus and how it seems to be more through contacts, people contaminate surfaces and then other people getting contact with the surface and then infect themselves. I don't see summer or warmer temperature in southern areas like Texas, Florida, have a huge impact. Maybe they will reduce the spread by 20%, but this is too easy to spread in the first place. The R naught probably is 5 or 6. So reducing that by 20, 30%, the R naught is still greater than 1. That means there's still more spread than, so people are producing more patients from spreading this to others.
So the best case scenario is that we just flatten the curve. We have most likely a second peak, but that second peak is quite shallow, and that we basically buy time until we can come up with a vaccine. Is that correct? Is that summarizing what you think?
Exactly. And the earliest time for vaccine to be available probably is in November and December this year. So by that time, in the best case scenario.
Barton, you think there could be a vaccine by November, December? Isn't that way sooner than the 18 months, which is the shortest vaccine that's ever been kind of brought to market?
Yeah, that would be the most optimistic situation where everything lined up and we're extremely lucky. The first vaccine ever tested turned out to be effective.
Oh, I see. Okay. So that would be the best case. So basically Christmas time or, New Year's time would be the earliest that we would see a situation where we might be able to return to normal. So if that's the case, do you think the market has got that figured out? Do you think that's in there, or do you think the market is still kind of clueless to that reality?
I think the market is still pretty clueless, and the market is reacting more to the policy from the Fed, from the Congress, than to the virus itself. And I agree kind of with the market, because how it may unfold in the next couple of months actually depends on how the government will respond to it. The virus itself is not that deadly if we're careful. Like for people below 95, I think if they're careful, the fatality rate is probably just 0.5 to 1%. If they're not careful, then even 20 years old can die of this. So in general, this shouldn't be a huge impact on the demographic below 65. And after the word, we should emerge pretty well. However, at this rate of spreading, I see like 40 to 50% of people, for example, in New York City would have got the virus before November, December. So at that time, they probably already have the herd immunity, and then everything the entire virus, this pandemic will run its course in, for example, New York, Chicago, some big cities.
Okay, so is that the most probable outcome that you think is going to happen, in terms of we aren't going to be able to change behavior enough through the social distancing, and that we are going to get into a situation where the vast majority of the people get it, and it will be the herd immunity that in essence saves us and stops the thing from really spreading? Is that kind of what you think as the base case?
Yeah, that's what I think is the base case. And then how the market responds will depend on how the government react to this potential reality, and then do they keep the social distancing on for another 2 or 3 months, or maybe even 4 months, or do they take it back or take a break on it after months, then restart again a month later, because the incubation period plus the time it takes for symptoms to show up is like 3 to 4 weeks. So they could probably get away with 3 weeks or a month of gap period when they restart everything. Then they probably will have to do social distancing again in a month, depending on what kind of a reaction they choose to do.
So Barton,
Now-
this is Patrick here. I want to kind of build on that. So like to me, I think that is one variable that the stock market may not be discounting, right? Like 'cause right now we're going to have like a historic drop in our GDP from the fact that they literally shut everything off. And
That's right.
we're gonna have this big economic impact. But would you think that if I make this statement that the market is more or less right now saying, well, this is going to create a short-term impact, but then everything's going to get started up again and the economy will be recovering? Would it not be a massive risk if we had to do a second shutdown? Like the stock market, I think, would take that very, very poorly.
Depending on how much stimulus the Congress will pass after this, because they've already talked about the fourth round of stimulus. According to my understanding, it could be wrong, in the CARE Act and what the Fed has been doing in terms of buying corporate bonds and doing loan forgiveness to big corporations up to 10%. Basically, they're handing out about $470 billion to big corporations. And if you count that as just free profit for big corporations, that is about 30% of S&P earning projected for 2020. So that's about slightly more than a quarter of earning, just given them for free by the government. If there's another round of stimulus like this, I think they can be shutting down for another quarter without hurting their earning per share.
Right.
Right.
Okay.
But now,
So, sorry, go ahead, Patrick.
Yeah, no, I was just going to say though that I mean that's certainly the justification of like preventing the companies themselves from having solvency issues and things like that. But I think the most immediate liquidity risk is the fact that the psychology of investors is going to be impacted and cause potentially another round of distribution in the markets just from everyone being so disheartened, right? Like it's. I understand from the balance sheet perspective, they should be able to weather the storm, but it's like I think the most bear markets, at least from when you kind of compare, often bear markets run like 6 months to even 18 months. And the big question here, with us only like a month or two into this bear market,
Right.
is there another significant leg to the bear market? And I think that's the big question, and it's on everyone's mind, right? Do you have an opinion on that?
Yes, I think so. And especially if the government kind of relented on the social distancing and then let people to go back to work in a month and then have to do it a second shutdown, a lockdown in late May. I think during the second lockdown, it will probably hurt the psychology or the sentiment of the market quite a bit.
Okay, so Barton, we talked about the most kind of likely outcome. We talked about the best outcome. Let's talk about the worst outcome. What could you see something really going wrong? What would you watch for, and what do you think it would look like?
Okay, the worst outcome will be we just said this is too much. We can't shut down the country like this, and then let's just restart everything in a couple of weeks. Like so let's say end of the April. I think that will probably be the worst case scenario because then the virus will hit the entire population pretty quickly, and probably like 30 to 40% people will get it within a month or 6 weeks because it's already very widespread, and you just need to infect the rest of the people, the friends and families. And that would cause a huge spike in the demand for hospitalization, and people really couldn't go to work, and you will see supply chain disruption because grocery store workers are not working, the food manufacturing, the food processing plant having shortages in workforce. That probably will be extremely disruptive to the society.
And so what do you think the odds of that happening are?
I hope it's less than 10% at this point. I don't. It's depending on the politics in Washington at this point. I think Canada will probably be more sensible than the United States. So the risk is more here in the U.S.
So your biggest worry is that they send people back to work too quickly. Is that correct?
Yeah, because this is. Initially, I was pretty hopeful for the quick rebound because this really is very lethal for older people, but for younger people, it's not so much. But in the U.S., a lot of people are really, really cavalier about the recovery, and then they don't take enough rest. And you see 20 years old, 30 years old, personal trainers who die from this, like people who never get a cold, or people who haven't got a cold for 4 or 5 years die of this because they don't pay attention to the inflammation and got into either heart muscle damage, which can cause sudden death for people who still exert themselves when they have this disease. Or just from massive cytokine storm and then causing respiratory failure. And if the hospital system completely collapses, then people couldn't get help when they need ventilators.
Right. So in Italy, we saw a situation where older people were actually turned away and told to go home, that they wouldn't be able to be cared for. And I guess it's a form of triage. And to me, that was always been the kind of the point upon which the public's going to revolt, and the scariest part. Do you think that that happens in the States, or do you think there's enough beds? And what do you think the odds of that happening are?
I think that probably could happen in city with high population density and reliance on public transportation, like New York City, Washington, D.C., Boston, Chicago. That's maybe Atlanta. That's pretty much about it. California, Florida, Texas will have a slower ramp up because people don't rely on public transportation that much. So the R effective is a little lower. But I just want to mention, actually, there are a very good case scenario I don't see any policymaker have been talking about. One thing we should have done a month ago is to have a lot of antibody tests available. And a good policy response here would be giving free or low-cost antibody tests to anybody who had a cold or who had mysterious coughing for weeks in the past month, and then test if they already have the antibody for the COVID-19. If they do, they can go back to work because they're immune to the virus because they already caught it. Right now, among my trader friends who live in Northeast U.S., so Boston, New York, Pennsylvania, and Chicago, like 30% people already had COVID-19 kind of symptoms in the past 4 weeks, and only like 10% of people get testing done. If we have antibody tests these right now, then a lot of people they don't have to do social distancing if they already have the antibody. It's like they didn't get the vaccine, but they got the virus, but then they recovered and then they're immune.
Well, you know what, Barton, that's a good kind of positive note to end it on. Thank you very much for spending time. For people that are interested in talking to you or learning more about what you're writing, where can they find you?
They can follow me on Twitter, Barton_options. They can also take a look at I have a blog just for the COVID-19, it's bartonview.bloggerspot.com.
Great. Well, thanks again, Barton. It's a pleasure having you on.
Thanks a lot, Barton.
Great to be back. Thank you.
Okay, Patrick, my favorite time talking charts. I get to sit back and just listen to you do your dark magic.
Well, you know what? I just want to talk to markets. What a crazy little while. I wanted to throw up some S&P 500 just to start off with the SPOOs, just to look at like this bounce. Like, okay, we had this ugly crash, right? I mean, this was this shit show drop where in just 30 days we basically wiped out 36%. Yep. We were looking and we got a bounce, and the bounce lasted exactly 3 days, and it's just been kind of dragging. Yep. And one part of me is like, if this is the best that they can do in terms of mustering up a bounce, then this is not good. Like I still think there's a legitimate chance that the bulls have one more little shot towards 2,700, 2,800. But if this is the place where it rolls over, there's another ugly leg coming if this is the best they can do.
Well, I'm going to have to take the other side of that, Patrick, again. Why can't we just meander here, which is what I think was most likely a slow drift lower as we have to deal with this situation?
What I do believe is that there was no way we're going to have a drop of the velocity that we saw in March. Like, there's no repeat of that. Like that, one of the reasons that volatility happened to that magnitude is everyone was caught on the wrong side of the market, and they all had to rebalance at once. And now much of that has already happened. So the likelihood that we have something of that magnitude to the downside is very unlikely, at least not of that velocity, but a slower bleed. Like would it shock you, Kev, if like, I'm going to just draw on thing, like if we saw something like this play out over the next, let's say 2 months?
No, not at all. I actually think that's kind of likely what's going to happen.
Right. It's just going to be like a step
ladder.
And
for those who are listening to this and not watching Patrick's fancy little chart diagrams, he basically just had a slow kind of drift lower that eventually bottomed at 1,900 or 2,000 S&P.
Right. And the thing that what makes it hard is with the implieds that are being priced in options right now, if it takes several months to get down there, a lot of the payoff profile gets eaten away with the theta.
Exactly, and that's what I think is going to happen. All those put buyers are going to end up just getting the theta monster or theta reaper is going to strike really bad.
It's going to just eat into their P&L, right? Like it's going to make the payoff of being short much harder, and therefore you have to use different strategies to create offsets. Something that is the
Patrick,
way.
How could you find out about that? Is there a way you could come up with some ideas about different strategies?
I do.
How would you do that?
I'm not telling you. You have to become a big picture trading member.
Exactly. Okay, let's go on to the next chart. What do you got for us?
What I wanted to just talk about the euro, like the dollar index got the bounce, but really the euro created a monster bounce off that and gave it all back. Not all of it back, but a huge chunk of it. And what's amazing is that if you look at, what do you call it, the Jaguar spread, or what do you call it, the Jaguar?
The BMW Jaguar spread, which is the euro versus the pound.
Yeah. Well, look at the pound that didn't move remotely the way the euro did, right? The euro completely gave back the bounce, and the pound held in. What do you make of that?
I don't know. You kind of caught me off guard. I didn't know we were talking about this, so I have to come up with something smart and pithy, and I don't actually have anything.
And you don't have anything. Okay, so
no,
perfect. That's all I want. We'll leave it at that. You had nothing smart to say. Anyway, so I just thought it was really interesting that the euro is overshooting and the pound isn't budging on it, which is really not what I expected to see. So I thought I was a little surprised by that. The other, I'm not going to pull up a chart on oil because we'll talk later on that. But it is interesting to see that gold is holding up, right? Like you have more or less a big rally. It gave it back, and gold is edging back up towards its 52-week highs. And this in technical analysis, we look at this as a kind of wedging, flagging formation that becomes midpoints. And it will be one of the really interesting things to see whether gold can actually pull volt to 52-week highs, because that will just that'll flash across everyone's screens. And it will put some tailwind behind it that could see 1,800 on the upside. I'm not predicting that yet, but it's like this is the environment where a breakout like that potentially can happen, and it's something we're definitely definitely watching. The other thing that I wanted to do though, Kev, was talk about some of the, just the sectors and which sectors have bounced and which ones are dogging it. And what's interesting is, okay, so you take what sectors have bounced the best off the low. First of all, I would say it's a mediocre bounce in technology. So here, where you're looking at the XLK, which is the technology, the spider technology basket.
It almost just looks. It almost
it's
looks like the market. Yeah, it almost looks
well,
just
no,
like
but it's actually it's like the market and like the and very much like the Qs.
Yep.
It's got a bounce. But the two sectors that I would point out that had the strongest bounce, healthcare. Right, the healthcare space got a big bounce, and so did consumer staples. The consumer staples names have actually had a pretty solid bounce relative. But
wouldn't you say that would be kind of expected, Patrick?
Yes.
Yeah. Okay.
Yes. And which sectors have been dogging it? And the award goes to the financials, which is like the KRE even worse than the XLF, right? Like the regionals are almost back down to their lows, and then you look at the XLF, which is just the money center banks mostly, and obviously Goldman's and investment banks and stuff like there as well. But like they just not only had an incredibly weak bounce, but couldn't even stick. Holding on to that pathetic rally,
right.
And so they're dogging it, but so are obviously all the consumer-driven names. Like if you like the autos, like this is the cars index, like Ford and GM giving it right back. You basically have the autos, the airline stocks right back down to their lows. Like there are those home builders. Like I know that you have a soft spot for this space, but they gave back the bounce almost right away.
Yeah,
they're right back down.
It's looking like shit. Like no doubt about it.
They are looking, but it's interesting. Anything that's driven by leverage consumer discretionary buying in some way or another, especially high ticket stuff like this, this space is just not getting bid at all. It's weakening right back down. And so it's interesting, but obviously one of the weakest by far sectors was energy, but obviously the energy popped a bit. But you know what, for that reaction that we saw in crude, I'd have to say that I give this a pathetic status to the reaction on XLE. Like if for oil to move off of its lows the way it did, you would think that this would have attracted buying pressure to a better magnitude of this.
I wouldn't have thought that, because the reality is that these companies are still with $30 oil. It doesn't matter, 30 or 20, they're still going bankrupt. We're still
not the majors.
No, not the majors, but
like like you're talking XOP, which is like the exploration.
No, but
shit.
why rush out and buy? Why rush out and buy the majors when we still have worlds of pain? Go look at the high yield energy ETF.
Okay, all right.
Yeah,
this is the value long term versus the short term pain, and the short term pain is not going away anytime soon.
Yeah.
So you're right. Like a lot of people, before they start buying these, they need to know that they've been properly bled out and left for dead, and
so
the consolidations have happened, and there's green shoots on the other side. You know, I'm already sick of green shoots being used in the media, and we're only like a month and a half into this bear market, and it's like, Jesus, what for? Like if I have to for 9 months listen to green shoots this, green shoots that, I'm gonna like. I'm gonna have to shut off every media source.
That's gonna remind me. I'm gonna use it all the time on you. But listen, I wanted to give a big shout out to my new favorite Market Huddle listener, who kind of listened to us, realized that we were both bearish on crude and energy, and said, "That's it. That's the contrarian signal I'm looking for." And he was buying. He's my kind of guy. That's my kind of thinking. That's smart stuff. I like that. Not afraid to fade it. Looking at us going, these guys are bearish. Even Kev's bearish. That's got to be terrible. That's got to be like a great buy signal. That's got to be a great buy signal. So the fact that I'm still kind of looking at this and telling you about the high yield spreads probably means that you should be buying it hand over fist.
There you go. Okay. Anyway, that's what I wanted to cover. So that was our talking chart segment. So let's move on. And
okay, Patrick,
Kev,
Oh yeah, this is me. What WTF clip of the week? I did one.
Well, you know what? You did one. And you know what? I think all our listeners even forgot we did this. It's been so long since you've been in the trenches with bullets flying over your head that you didn't have time to.
I like
you didn't have time to like mess around on the internet.
Okay,
and edit a video. Right?
I'm sure to piss off somebody with this one, but I couldn't believe it when I guess a couple of weeks ago Trump said that we were going to open up the economy by Easter. Remember that?
Right. Yeah.
And I saw on Twitter somebody said he went and took a meme and he took the scene from Jaws, which is for our millennials, it's a great movie, horror movie based in the 70s or early 80s, can't remember, about a shark that basically terrorizes a community. And he took the mayor who kept trying to open the beaches and he put something there like saying the beaches will be open by Easter. And I thought this was the most hilarious meme, and I thought it was the funniest thing I'd seen on the internet for the longest time. So I decided to make a WTF clip of the week for it.
All right. So let's watch.
At some point, we're going to open up our country, and it's going to be fairly soon.
Weeks or months? Because you seem.
I'm not looking at months.
A big one. And any shark expert in the world will tell you it's a killer. It's a man-eater.
Look, the situation is that apparently a great white shark has staked a claim in the waters off Amity Island. And he is going to continue to feed here as long as there is food in the water.
And there's no limit to what he's going to do. I mean, we've already had 3 incidents. 2 people killed inside of a week, and it's going to happen again. It happened before. The Jersey Beach.
1916, there were 5
people chewed up in the surf.
In 1 week.
Tell them about the swimmers.
I can tell you right now, we're going to be opening up our country.
Look, we depend on the summer people here for our very lives.
You are not going to have a summer unless you deal with this problem.
But you can't keep it closed for the next, for years. Okay.
Larry, we have to close the beaches. Brody?
Okay, this is going away. We're going to win the battle, but we also have, you have tremendous responsibility. We have jobs. We have people get tremendous anxiety and depression. And
we're going to put on the extra summer deputies as soon as possible. And then we're going to try and use shark spotters on the beach.
Are you going to close the beaches?
You have suicides over things like this. When you have terrible economies, you have death, probably, definitely would be in far greater numbers than the numbers that we're talking about with regard to the virus.
Yes, we are. We're also planning to bring in some experts from the Oceanographic Institute on the mainland.
Nothing would be worse than declaring victory before the victory is won.
U.S. President Donald Trump on Sunday extended to April 30th the federal guidelines to slow the spread of the coronavirus, measures that include social distancing and limiting gatherings to 10 people that had already been in place. Trump changed course from his original target date of April 12th, when he wanted to reopen the U.S. economy, noting that the coronavirus could peak around Easter.
Good job.
I should have ended with we're going to need a bigger boat, but I just figure everyone always ends with that one.
We're going to need a bigger boat. That's awesome. I think it's self-explanatory. Anyway,
no
good
need
job.
to talk about it anymore.
All right, let's move on.
Okay, Patrick, this week in trading history, what do you got for us?
Well, it was interesting that Steve was talking about what was it? What did he say? It was like
May wheat.
May wheat. 10 contracts of May wheat is
worth more than a Harvard MBA.
Exactly. And I thought that was so funny because we didn't even prod him to say that. But I want to go back to the wheat scandal of 1925. It was on April 3rd, 1925. It was known as the Black Friday in the Chicago wheat pits. And it's a character we've talked about many times in the past, Jesse Livermore, was the man of the hour that is the key of the story. And it was another very well-known operator in the pits, Arthur Cutton, that was on the other side of it. So let's actually talk about what happened there. But the rumor was that on this day, the shrewd Jesse Livermore hammered wheat prices short with 5 million bushels of wheat and sent wheat prices falling. By coincidence, his arch rival, the famed speculator Arthur Cutton, was long 20 million bushels of wheat while he was on vacation in Florida. And so what was clear is Arthur was married, and his wife thought it was a good idea for them to leave the Friday to Florida, right?
Right.
And it's always the wives that mess this up, right? And
Oh,
it's like the vacation
Patrick,
has to start.
that sounds very derogatory and not very politically friendly. I'm sure they had a discussion as a couple and came up with the solution that was best for both of them.
Absolutely.
Yep.
And so nonetheless, Jesse.
Okay, so
hammered
one
him.
second. I got to be honest
All
with
right.
you. She told them they were leaving on Friday. Let's just be honest.
Yeah.
Right? Like, that's what happened.
Yeah, that's what. So anyway, by the way, so a lot of people are familiar with all the books written about Jesse Livermore, but there's a great PDF that's a fun read. It's called The Story of a Speculator, and it's the story of Arthur Cutton. And so it's a PDF that you can just download for free. Just it's Google The Story of a Speculator about Arthur, and it talks about the story, and he kind of carries. He talks about this actual trade. He says, I was carrying a big line of wheat, bigger, I suppose, than that of any other individual trading in it anywhere. But in my opinion, it was not too big. I could pay for what I had. That day, the market was strong. May wheat was trading like at $1.66 a bushel. I had bought most of his line in while it was selling less than $1.50. But what ended up happening was, so he was looking at the situation in the wheat markets, and he justified, obviously, that the conditions were good for him to take his position. And he says, by every right of commerce, I was entitled to a profit on my transactions for the risks I had taken. Then I received a notice to appear before the Business Conduct Committee at the Board of Trade in the offices of the directors. And basically, he took such a huge line in the wheat that he was distorting the markets. He was, I guess, cornering the market. And Jesse, by the way, was long with him. So actually, on the way up, just to kind of jump in here, Jesse bought wheat earlier than him in early 1925 at about $1.04 a bushel, and sold most of his right at the top near $2 a bushel a few months later. So his timing, Jesse's timing was perfect, netted him like $10 million, which was a lot of money back then.
Yeah. Like $10 million back then in the 20s?
Back in 1925.
That's $4 trillion or something today.
It's not like today where that would buy you like a one house in Toronto, right?
You get two, to be fair.
Yeah, to be fair. All right. So anyway, the guys at the Board of Trade were trying to tell him, you ought to sell some of your wheat, and he's basically he was reluctant. He was basically saying, that he protested. He's basically saying that because there's nothing criminal in an honest profit. He goes, I'm buying with the risking my own money. Why should I sell before I'm ready to sell, right? And so, and yet the Board of Trade was pressing him on this issue because he had it cornered, and basically Jesse came in there and took care of business. And so not only did he take his profits on the way up, but once he saw it dipping off of the highs, he started hammering it, including down near the low. He basically put 5 million bushels into the market in short order to create that liquidity drought. Back then, those stock operators were far more shrewd and could move markets with that kind of money. There isn't too many players today that can move markets that much. I mean, there are, but back then, that was what these big players did, right?
Right.
And so anyway, it came down to it that May futures contract it traded down to about $1.19 afterwards, and it was one of the worst days in wheat, and it created a huge scandal. There was outrage amongst the wheat producers. The U.S. Department of Agriculture and the Grain Futures Administration were all over this. They started to rip this apart, and they were talking about even regulating the wheat market after the two of these big boys started going after each other. But it was April 3rd, 1925, which was that Black Friday in the Chicago wheat pits, that the scandal of 1925, buddy.
That's awesome. Great story. Thanks for sharing that with us, Patrick.
All right. It's time for top 3 things to watch next week, Kev. But before we do, let's review what were last week's. So the last week we said number 3 was, does Cuppy get mercury poisoning from eating all that tuna? And now what I'm saying is if the mercury didn't get him, the shipping socks would.
Yes, it was an ugly week for the shippers, I must say, and
like that was. What I wonder, like, what's your opinion on this? But like, do you think it's just because a bunch of shipping tourists get in there and they're too easily shaken out, and it's just not a liquid enough market that when the waves of buying and selling come in, it creates these extraordinary whips? Because I don't think the fundamentals shifted that much to create this magnitude of swings. Do you have an opinion on that?
No, but I agree with you. There's a lot of hedgies playing it. It's a lot of fast money going in and out, and it's and listen, they're volatile stocks, and like Cuppy will be the first to tell you that that there's a lot of vol in those things, and I was watching them, they go up and down 15% every day, right? Like it's like up 15 and then down 15, and it's just like it's definitely, you should trade it a lot smaller than your usual positions. That's the only thing I can say. But I'm sure you know what. So I'm sure Cuppy has a very reasonable size position. Don't worry.
So number 2, wow, how about that jobless claims number, buddy?
Yeah, it was big, right? What did we say? I can't remember, but
6 million was what came in at, though.
I think I was pretty sure we were saying that it could be big, right? Like, and I think we actually got this one.
I know we were, but the market didn't really sell on it. It sold for a moment.
Do you know what's amazing is Canada, we're a tenth of the size of the U.S., and ours is like running $1.5 million. That would imply 15 million in the U.S. I think there's more to come. I'm still like at the initial jobless claims. They're still coming.
They're still coming. There you go. And so number 1, do we see crude oil in the teens? And yes, we did. Yes, we did.
For what, 10 minutes?
Yeah, but it still got there.
Okay, but like that was like, I'm telling you.
You know what? No, but you know what?
That tweet, that kind of whatever you call it, top 10 or top 3. That implied a certain level of bearishness. It's the greatest signal around.
Right. Okay. But okay. Now, I did have an opinion that the purpose of it dropping below 20 was that so every media source can run the headline that, oil's down in the teens. Like there was stupid headlines out there in oil, like which contract, Texas or Western Canadian Select will hit zero first, right? Like, so when you're not even saying how much lower can they go, they're implying one of them is going to hit zero. Which one is it going to be first? When you read shit like this, that something's got to give. That you can't have media writing stories like that, right?
Well, you're right, and in hindsight, it was a great signal. And if you had the guts to stand,
but really, but you just really needed to remember that Trump had a Twitter account, and it hasn't been banned yet.
Yeah. Well, what's amazing about Trump is for the longest time he didn't realize that oil going down was bad for the economy. He just didn't understand that. And I get it. Like over the long run, it's good for the economy. There's no doubt about it. Like that, if we think about like our ability to be economically more productive, there's nothing better than lower oil prices. Having said that, over the short run, lowering of oil prices causes a deflationary shock, which then feeds upon itself. And so, if you're Trump, you should have actually been hoping the other way the whole time. Anyways, let's go on. Yeah. What do we got? Top 3 things to watch next week.
Next week? Well, first of all, I wanted to talk about exactly you were talking about, the Canadian unemployment rate and claims coming out in the tail end of next week. And it'll be really interesting to see because, in Canada, it's been pretty hard hit as well. And just how bad will these numbers keep going? You think though that number was the one we saw was as bad as it gets, or you think it's still going to get worse?
No, it's going to get worse. More and more people getting laid off. Listen, we're a long way away from the bottom yet. You can't tell everyone to go home and then not expect layoffs.
Yeah, it's a
problem. Agree. It's a real problem, and not only that, I think the real issue with both the market and like the economy, Patrick, is that I think last week was the week when the market started to realize that this wasn't going to be a restart by Easter. and kind of were laughing about Trump's thing. But remember, he came out and did a somber kind of declaration. They said that we're going to have to make it a little bit later, and this isn't going to work. And I'm even wondering if the current guideline's not going to be enough, that we're going to be here a lot longer. So my kind of feeling is that we're going to get a hold of the virus from a kind of transmission and dealing with it. Kind of the worst is probably behind us, or at the least the worst versus expectations is probably behind us, because the markets are expecting a lot for it to get a lot worse. But even then, after we get through that, I don't see how we fix it. I don't see how we all go back to work. And this is what I think the market is starting to wake up to. How do we go and do the next step? Sure, we can stop the panic selling. Sure, we can stop the transmission eventually after we kind of deal with the initial kind of, let's just say, transmission when we weren't paying attention. But after that, there's no easy solution. Here in Toronto, they just announced that the government was going to run we're looking like we're not going to be back to work till later in June. Anyways, I'm ranting. So let's go on to number 2. What do you got there?
Now, number 2, I wanted to talk about the PBOC and the Chinese renminbi. And I'm going to float an idea for you, and you can call me an idiot. Go ahead and just tell me that this is stupid. But I look at geopolitics in a very kind of art of war kind of perspective. And the time when you make a major geopolitical move is when you have the least political consequences for doing so. And so the Chinese allowing the renminbi to slip in an environment like 6 months ago, they could never get away with it. But with the coronavirus having caused the damage it has, and more importantly, because it's the headlines everywhere today, I mean, will anyone be talking about it if the PBOC lets it slip? And so this is where I'll put a chart. I want you to comment, but the price is incredibly weak, and it's deteriorating at the bottom end of this range. Do you want me to look at U.S. dollar?
No, you could do it your way, your crazy way.
Yeah,
even though all of our listeners know better and they give you a hard time.
Okay, sorry. No, let me just look at it this way. Sorry, there you go. It's trading at the 710 level. And so you have the scenario that if you, let's say, put on a weekly chart, we're on the verge of breaking out of a decade to a decade high if it was to break the 720 handle.
So, Patrick, I'm looking at this chart. It does look bullish. It looks like one of those cup and saucer crap or whatever. I will say one thing. You said, would anybody notice if all of a sudden it broke out to new highs? I can tell you one person that would for sure notice. Kyle Bass. I'm pretty sure he'd make sure we all notice. He's got a bee in his bonnet about this. I don't know, Patrick. I hear what you're saying. I don't disagree with the logic that if you're going to do it, this is the time. Having said that, I'm not sure what it accomplishes for them, and I'm not sure they actually want a
Well, their economy's in the shitter, dude. They need.
But you know what? I don't know, Patrick. They're not going to be selling more stuff.
The price. Okay, listen. Let's not make this a forecast. What I'm saying is one of the 3 things to watch, not only next week, over the next month, is are we going to see this currency move, or am I just bringing up something that is not...
No, I like it, Patrick. It's good. I'm going to get... You know what? It's good to bring in top 3 things to watch. What's number 1? What do you got planned for us?
Number 1, well, the oil production cuts or tariffs, or is it on Big Nothing Burger, this whole Trump...
Well, I'm actually really worried about saying something here because I think that we're both in the same camp. And then I'm worried that we're going to goocher it. So why don't you tell me what you think, and then I'll either confirm or deny, or just keep my mouth shut.
No. I'll tell you what. I'll just do the opposite of you. Actually, first of all, I do believe that it's complete nonsense that there will be a production cut, and so I think that if a production cut anywhere near the absurd 10 to 15 million barrels a day that they're talking, that is nonsense, right? But there might be a small cut. But the bigger question is Trump capable of throwing tariffs up because he's pissed off that there's no production cut? And I believe Trump is capable of that. So I'm a seller on the idea that we'll see the production cut. But I'm worried that the tariffs are coming. What's your take?
No comment. Don't want a good shirt. Don't want a good shirt. Anyway,
so you do, there is though a legitimate chance it's a nothing burger and oil fades this whole thing. And I think that this would be something like if this entire rally is proven to have been a fake out, then no one's going to trust what Trump says about oil after.
Oh yeah, because you're right.
And
He's never said anything wrong, and he never kind of shoots his mouth off. That'll be it. This will be the time. This will be the time. You're right, Patrick. That's some wise stuff, buddy.
Wait, you know what? I'm going to take that back. Now that you said that, I realize how stupid what I just said.
Okay.
Thanks for correcting my bullshit.
Okay, let's go with the fun. Let's wrap this thing up, Patrick.
Yeah. All right, parting wisdom.
Okay, I'm going to do. It's a Warren Buffett one, and I thought it was extremely applicable to this environment. I wrote a piece this week about Warren Buffett, so I thought that it would be just nice to use one of his kind of folksy wisdoms, idioms that he does. So anyways, let's go with it. We simply attempt, he's talking about his firm. He says, we simply attempt to be fearful when others are greedy and to be greedy when others are fearful. You know, the thing about this, Patrick, is it sounds so like, I don't know, easy to do and stuff like that. But if you think about it, he was taking so much flack for being long all sorts of cash up there at the top. People were selling his stock, saying he didn't know what he was doing and stuff like that. And right now, he is buying shit. I don't care what anyone says. He's buying stuff right now. I bet you he's even buying.
He bought Delta. He bought Delta recently, didn't he?
I don't think he's announced anything.
He bought some Delta Airlines. I think he bought a little bit higher than where it's trading, but he was buying the airlines on the way down.
So I think that you're going to look and he's going to have been buying this whole time, and we're going to see that he's.
You know what? A perfect example of that is that when he came in with was it Home Capital or whatever up here in Canada, where he came and bailed it out. It's like I was so bearish. And,
that's a shocker. I do remember that. You were so bearish.
Came in.
Yeah,
I still have to eat that hat.
Yeah, you did.
I remember I have that hat that.
Anyways, that's the parting wisdom.
Shout out to Rob for making the hat for me. But anyway, it's good parting words of wisdom.
Okay.
So anyway, that's what. So listen, that was a great episode. Thanks everyone for joining us.
Yeah,
we appreciate the time you take to be here. Hopefully, you get a lot of value out of this. Thank you to Steve Sosnick for joining us and Barton for coming on for giving us an update on the coronavirus. As well, make sure that you follow us on iTunes. Give us a rating if you can, just to help more people find us. We're also on Android Play, Podbean, Spotify, and of course on YouTube. When you want to watch the charts, follow us on Twitter at The Market Huddle. You can follow Kevin. Kev, where can they follow you?
Well, 1 second, Patrick. That was unbelievably well done. Did you write that down?
Yeah, I wrote. I'm reading your script, right?
It was pretty well done. Anyways, yes, you can follow me at Kevin Muir, Muir. And Patrick, where can they follow you?
You can follow me at Patrick Ceresna, and you can also find me at Big Picture Trading. And you could make sure you learn about Kevin's. Kev, you went subscription based, right?
Like I know, Patrick.
You took the.
I did. I made the.
No, I'm just going to give you the plug. The Macro Tourist is but you know what? I've been reading them ever since you started subscribing, because you now feel like people have to get their money's worth. So you've actually given some amazing trade ideas ever since you went subscription based. So everyone who thought his shit was garbage before, it's actually gotten better since.
Well, even, as I like to say, even the blind squirrel finds a nut every now and then. But thank you very much for that. It's very kind of you to say. Listen, and make sure you guys follow them on Twitter at The Market Huddle, because that's not us. That's actually Lena. I know everyone likes Lena way better than they like us. And if you want to converse with Lena, you go and follow her.
No, we have to do something. Also, Lena has a Twitter account, and no one knows Lena as Lena.
No,
just tell people to.
Yeah, I don't think you should do that. You just go follow her at The Market Huddle.
All right. Well, all right.
Poor Lena. She wants to keep that separate. She doesn't want like strange old men following her. That was very poorly done, Patrick. Very poor.
All right. Well, anyways. Lena, you can edit this out if you want.
Okay.
If you don't, leave it. All right. Anyway, so well, that's it. Is there anything else we forgot?
No,
we're gonna bring Lena on here. Give me shit.
Yeah, Lena, come on.
Lena, come on. Hop on here. Did
like a
I
little
screw
bit
up?
of an anonymity.
I know. It's like, what
Okay.
the hell? He's like giving out your personal Twitter. You know, like I was like,
Yeah, nowadays
I was gonna give you
anonymity
your
is
phone number.
golden.
yeah.
I was gonna give out your phone number.
Oh,
Yeah.
phone number.
Patrick, the fact that you're
easy to
you're
change.
showing your age, Patrick, by even saying the phone number, because most people don't actually have phone numbers. Like, they don't know their own phone numbers. Like, have you ever seen that
True.
thing when, what was it, 21 Jump Street? When they go...
Probably.
21 Jump Street with Channing Tatum, who's on my wife's...
Channing Tatum.
who's on my wife's... what's that list called when you're allowed to have sex with?
I can't remember what it's called, but the list.
The celebrity,
Yeah.
the celebrity list or whatever it is. Yeah.
Yeah,
Anyways,
yeah.
And I'm always like, but he's so stupid. And she's like, exactly. But so anyways, so that 21 Jump Street, when they go back to high school, and he calls this girl up for a date, and then she's like, what the hell? Why are you calling me? Only my grandparents call me, right? Like, that's basically like how kids are. Nobody calls, Patrick.
No, you text each other to
Exactly.
see, hey, do you have
But you need
time
a
for
phone number to
call?
send a text message. You guys stop this. This is ridiculous.
Yeah, but
Patrick has a lot to catch up on.
I know. So, Patrick, what have you been watching this week? What are you going to tell us?
Yeah, what was your homework last week?
He's telling us there's
Well,
a really
actually,
good,
this-
there's a really good Seinfeld episode he just found out about.
Actually, this past week I haven't been watching, but I was last week. I was telling you as I was watching the Succession. I didn't catch up on any. It was a really busy week for me.
Okay.
So but I'm gonna this weekend have a little downtime. Actually, probably tonight I'm gonna catch a movie with the kids. Yeah. What any recommendations for a movie I should watch with my kids?
I don't know. I don't.
Kids, I don't know.
I don't really know.
I haven't seen any of them, so I mean,
Yeah,
odds are whatever movie you say, I haven't seen it.
Well,
Jojo Rabbit.
I haven't seen that. Is it good? I should see it.
That's a good one.
Yeah,
That's
there you
actually
go.
a good
Is it?
one.
Seems a
I was
little
gonna say, I'm
seems
like-
a little sophisticated for Patrick. It really does.
Well, the main character is a child, so it's not that sophisticated.
Yeah, I guess that's saying something. And you get
But it was good.
Charlize
I thought it was
Theron,
good.
so like anything with Charlize Theron, you got to be like, I'm a buyer.
Wait, is Charlize Theron in that?
Or is it Nicole Kidman? Who is it? It's one of
You're talking about Bombshell.
No. Let me go look. Oh no, Scarlett Johansson.
Yeah, I was
Yeah,
gonna
that's
say,
it. I'm sorry, I got it wrong. Yeah, I got my blonde.
You just went through your 3 top list, right?
Yeah. Well, I am a big fan of Scarlett Johansson. It's tough not to like her.
I mean, she was, voted one of the most attractive women in the world many years.
Yeah. So I actually, yeah.
But, Jojo Rabbit, if that's too quote unquote sophisticated, watch Tiger King on Netflix.
Oh my God! You know what? It was funny. My daughter and my sister were like telling me all week, like, you gotta watch the show. Like they're like all into it.
It's a train wreck. You can't.
I know.
Lena,
I'm actually not going to watch it because I actually feel like it's sad and it's almost like you're laughing at the people, and then they're mean to the animals. I hear.
It is kind of, but yeah, it is sad about the whole animal situation.
Yeah.
But it is definitely entertaining to a point.
Yeah.
But it's like I said, it's a train wreck that you can't, you don't really want to look at it, but you can't not, if that makes sense.
Yeah. No, I understand. It's like a car accident.
Yeah.
Yeah. No, I hear you. Well, Patrick, I don't know. You got so much to choose from, buddy. You could just turn it on and randomly pick something.
Or Ozark, the new season.
Oh yeah, there you go. But Patrick doesn't even know what that is, and he's gonna have to watch the first 2 seasons.
Oh Jesus.
Right? Patrick, do you know what Ozark is?
I'm not going to say anything.
Exactly.
I don't know what you're talking
Yeah, he
about.
doesn't. He doesn't. Well, I'm gonna go because I gotta go have dinner, guys.
Yeah. All right. It was a good episode. I'm a little longer than expected, but Steve was awesome.
Yeah, no, it was
And so,
terrific. It was great.
Yeah, Barton was great too.
Yeah.
Like, it was good to have an update. Listen, when you have good content, you might as well make it a longer show.
Yeah. Well, why are ours so long then? Anyways, have a great weekend, everyone. See you later.
Thanks a lot.
All right.
All right. Cheers, everyone.